So a client wants to know, is setting up a captive insurance company a good tax strategy for high income business owners, or is it too much of a hassle?
There's a little bit of hassle to it, for sure.
I was going to say that too.
Yeah. So what captive is, or it goes by different names. There's 831s, there's captives, there's reinsurance. All these different terms are the same basic strategy. So what it is, there are special rules for insurance companies. When you pay a premium to an insurance company, that premium is not income for the insurance company. The insurance company takes that premium in, and they have, on an actuarial basis, they have a liability on the other side. So it almost operates like a loan. And what they do is they take that premium money, they invest it into something. It's usually bonds or real estate or something like that, something very humdrum and not too volatile. And the gains on the investment are taxable income to the insurance company. The way captives work is that you have a micro insurance company of your own. And there's a lot of rules that go into this as far as, how much coverage you have to have. You have to have a certain percentage on any one client of that micro insurance company. Basically, there are providers out there that organize all this for you and match you up with different pools of insurance in order to make sure you comply with all the rules. So basically, your operating company will take out an insurance policy with your insurance company, and the operating company will pay the insurance company a premium. It's a high dollar premium because these are things you cannot buy insurance for in the normal marketplace. So I can go out and I can buy insurance. I can buy property insurance. I can buy a number of different types of insurance, but I can't insure against the risk that Amazon turns off my listing if I'm an Amazon seller. I can't buy an insurance policy that, so-and-so savages my reputation online. So these kinds of risks, they are business risks, and I can't go out and just buy insurance to cover it. That's where the captives come in. So they write these kinds of policies, and the actuaries do all their calculations as far as, what an appropriate amount of coverage is and what an appropriate amount of premium is for that coverage and all those kinds of things. So your operating company will then pay that premium, and it's just an insurance expense to the operating company. So it's going to lower your taxable income by whatever that premium is. And then it is not income to the insurance company because, again, special rules for insurance. So the insurance company then creates a policy, takes that money, usually puts it into, like I said, something very safe and liquid, that they'll be able to access that capital if they need to make a payout. And then usually after 1 or 2 years, then that money, that insurance policy will expire, and then that capital is freed up, assuming there wasn't a claim. If there was a claim, then you pay out to the operating company. If there wasn't a claim, which most insurance policies do not pay out because the insurance, the whole idea is to create pools against unlikely events. And there's such a thing as insurable risk versus uninsurable risk, which is beyond what I want to talk about right now. But most of the time, the insurance company does not pay out. And so now, after a year or two, it's left with a pot of money that this premium was. So now the question is, what do we do with it? And basically, at that point, there are options to reinvest it into something else, into another investment. You could take a dividend as the owner of the insurance company because these have to file as C corporations. And so at that point, you have your choices. And regardless of what you choose to do at that point, it is going to be a lower effective tax rate, either possibly 0%, possibly half of whatever your ordinary rate is. And that's just because of the structure of how the payments work and the time delay of everything. The question was, is it a good idea? And the answer is, if you have business risk that you can't insure or you can't buy a standard policy for, and you don't need the cash flow because you're basically locking these premium payments away into this insurance policy for 1 or 2 or 3 years, whatever it is, then it works out great. You got to play by the rules. You got to use a reputable insurance carrier that's going to help you organize all this because, again, there's a lot of specifics that go into it. But it's a great strategy if the situation works for you. So most important things is that, one, you need a lot of income because these insurance companies don't want to mess with you if you're too small. The second thing is you don't need all your money. You can live on a lesser amount of cash flow than the business could throw off. But if those things satisfy, and obviously the insurance risk issue. So if those 3 elements work for you, then great. Let's talk about it.
So it depends.
It does depend. Yeah.
Okay, understood. And it looks like we have an escrow question.